3 people. Same year, same $50,000. Same market. One of them will spend the next decade glued to 5 screens. One will check in every few days. One will barely look at all. Most people assume the busiest hands make the most money. That the trader watching every tick has an edge the passive investor will never have. It feels obvious. More effort, more control, more reward. But here's the question almost nobody actually runs the numbers on. After 10 years, after taxes, after fees, after the hours spent, who actually ends up ahead? Let's keep this fair. All 3 start identically. $50,000 in capital, deployed on the same date, into the same broad market, the S&P 500 universe. The day trader executes roughly 5 trades per day, every trading day, chasing intraday volatility. The swing trader holds positions for days to weeks, riding short-term trends. The index investor buys a total market fund once and does nothing else. Same starting knowledge, same data access, same starting point. No advantage given to anyone. This isn't a hot take, it's a controlled experiment. Here's why one of these paths feels obviously smarter before you've run a single calculation. Day trading offers constant feedback. Wins and losses arrive in real time, which feels like skill building. There's a community for it, forums, screenshots, a story to tell. Swing trading feels like the mature middle path, active enough to feel earned, calm enough to feel sustainable. Index investing feels almost embarrassing by comparison. No story, no control, just waiting. But feelings and math are different things. Look at year 1 in isolation and the active strategies appear to dominate. In a strong month, the day trader nets 18% on momentum plays. The swing trader captures clean trend trades for a steady 12%. The index investor, doing nothing, posts a flat 9%. Side by side, gross returns, no deductions, the day trader looks like the obvious genius. The swing trader looks reasonably rewarded for moderate effort. The index investor looks like they're leaving money on the table. Until you subtract what nobody talks about. First, tax treatment. Short-term gains, anything held under a year, get taxed as ordinary income, up to 37%. The index investor's long-term holdings get taxed closer to 15 to 20%. That gap alone erodes a huge share of the day traders. Win. Second, transaction costs. Spreads, slippage, and fees across hundreds of trades a year compound quietly into thousands of dollars of friction. Third, time cost. Day trading consumes 30+ hours a week, an unpriced opportunity cost against a career, a business, or simply rest. Fourth, behavioral drag. Decades of data show the average active trader underperforms the market itself, because overtrading and panic exits erase exactly the edge they were chasing. The gross numbers were never the real numbers. Now zoom out. Year 5. The index investor's account has quietly compounded past the day traders, who's been treading water against tax and fee drag despite winning most months on paper. The swing trader sits in between. Better tax treatment than day trading, less time cost, but still bleeding a percentage point or 2 annually against the simplicity of just holding the market. Year 10. The index investor's $50,000, compounding undisturbed, has grown past $115,000. The day trader, net of taxes, fees, and the inevitable bad months, has often grown less, sometimes barely outpacing inflation, despite years of daily effort. A cost differential of just 3 to 4% annually, compounded over a decade, becomes a 6-figure gap. Small structural drag, magnified by time, is the real story here, not who picked better trades in any given month. None of this means active trading is irrational. Day trading can build real, transferable skills, pattern recognition, risk discipline, emotional control under pressure, that pay off elsewhere. It offers liquidity and speed that a locked-in index position doesn't. And there are genuine outliers who beat the market net of every cost. They're rare, but they exist. Swing trading is a legitimate middle ground for people who want engagement without the day trader's grind. The index investor's win isn't universal, it's conditional on the investor not needing speed, control, or quick capital access. So the real lesson isn't passive beats active, it's that every strategy is a trade-off between time, tax efficiency, and control, and the only real mistake is not knowing which trade-off you're actually making. The market doesn't reward effort, it rewards what survives the math. So ask yourself honestly, Are you trading because the numbers justify it, or because the activity itself feels like progress? The answer that includes everything is the only answer that matters.